Welcome, everyone. This is episode 34 of the new Barbarians podcast. Today is Monday, September 8th, 2025. We will do our best to get the podcast on the platforms later today.
Bill, it's never the same day. Come on, you never do that. It's always going
Well,
to be
we're going to still do our best.
All right,
Ever
very
since
good.
Mark and I became the post-production, what would we call ourselves, engineers, it's taken a day or two, so we'll still do our best. And either way, the live version will be up immediately. Today's guest is Charlie Marin, CEO of Quanted. A few months ago, we were joined by his co-founder David Farino, who is the CTO. So today we're going to talk a little bit more about the startup journey. And as I mentioned last time, I've been an advisor to Quanted for about a year now, and subsequently also became an investor in the seed round with my partner Debbie through Harmonic Insights. And I've gotten to know Charlie quite a bit over that year. And even last year around this time, I believe we were doing a bit of a road show in New York City, which is where Charlie now lives. I might say hello, Charlie.
Yeah, hello everyone. I don't know, Bill, do you remember how you actually got into contact with us in the first place?
I think I reached out to David through LinkedIn, or
it was actually random. we had an old deprecated version of the app that was in our last company, and you came in through the chatbot on there that we didn't even know still existed. That was the way it came in, and then we started reaching out back through that channel, and then found you on LinkedIn and went through there, and that's how we had our first call. But it was humble beginnings to what is now a very lovely, fruitful relationship.
Very interesting. And I do recall I was in a hotel in North Carolina because I was on a ballet trip with my daughter, which is a pretty common thing for me as well. So I'm going to run through a few updates, and then we'll pass it to Mark, and then we'll jump in with Charlie. So I did actually play around a little bit with my quantitative macro model, and just given last week's updates that unemployment was higher than expectation, like anytime we have a surprise, it's potentially worth considering how significant this surprise is and whether or not it puts us in a new regime, etc. And I was basically debating with an LLM, are we still in a bear steepener or is it bull steepener? And it sounds like we're probably going for the latter once the Fed cuts rates as a result of this bad news we got last week. And then, that means we would recommend overweighting cyclical and value sectors, and the associated quant factors as well. So value should do well, I believe, but I'll have more coherent notes about that I can put into the show notes, and I think we'll be publishing a bit more research as well.
Bill, how would EM focus when you just said value and you didn't say industrials, you used another sector, I forgot what it was. Cyclicals, right. Sorry, I just went a little bit, I moved too much from my camera here. Cyclicals, okay. So cyclicals, less of that secular tech trade, because a lot of Wall Street firms are now coming out saying EM, which are commodity based. So they're, back to factors, they don't mean EM. What they just mean is, quote, value or commodity-based entities. And it's just so funny how that, like, one theme goes through and everyone says, oh, I like this now, but it's the same factor driving it, basically, is maybe metals, natural resources, and low PEs.
And rates, right? So when we talk about commodities, we're always talking about rates.
Interest rates.
And so I have the Wolf update from August and last week.
What does that look like?
So I guess growth factors struggled in August. And, I think a lot of this is in anticipation of the upcoming rate cut. Long duration free cash flow growth did well. So, it's kind of more in the value and quality crossover as well. So value performed well. Book to market being the most common one, but it looks like the majority of value factors did pretty well. And then I'll skip over some of that quant stuff. And so reversal is continuing to do really well because I think we are seeing a lot of gyrations in momentum rather than a continuous slope. And retail investors did well in August. And then the short interest factor, I believe, has been selling off, even though it, rallied in July. And so, I guess to tee you up again, Mark, the chance of a 50 basis point rate cut has risen from essentially 0 to 12%. And then,
there's 50
there's
basis cut is you're showing 12% in SEP?
Yep.
I think it's higher than that.
I would have thought it'd be higher than that now.
Yeah, I
may
think
have
it's
even
12
seen
not.
that.
I think it might be 88%.
Of a 2?
Of a 50 basis
Or
point, I thought.
a 50 basis?
You think, all right, good. We'll check that before the hour's out, folks.
Yeah, and that was as of Friday.
It might be 80
anyway.
for 1 and 12 for 2.
That would make sense to me.
Yeah. You want to know the chance of my fantasy football team winning?
Markets are pricing 90% of a 25 bips cut next week. 10% of a larger 50 basis point cut.
Thank you. Yeah.
So you're
Bill
right.
got that right.
Yeah.
Okay.
Yeah.
Thank you for looking that up, Charlie.
All good.
So and as I mentioned, short interest sold off a bit last week because people decided they didn't want their distressed, speculative, crappy stocks after all. And but like in the statistical significance space, like none of this is all that surprising. So kind of business as usual from a quant perspective.
All right, let's come back to that business as usual from a quant perspective, because you just used the word gyration. You talked about August having one trend and then September another. And so Charlie, you're gonna do a little sifting through and showing how maybe people can make sense. Because if you can look up in 5 seconds what the interest rate probabilities are, how valuable is that in information? Everyone knows it. How spurious is that information? How persistent is it? And I'm going to go into, say, 2 things here. August was meaningful because it was the largest large cap to small cap rotation since 1984. It was almost 700 basis points, I think, or 500 or 600 basis points outperformance by the S&P, by the Russell 2 versus Russell 1. And going back to the 80s, Charlie lives in an old neighborhood we were talking about down on Lower East Side that I lived in the late 80s, and it's much nicer now than it was then. But the reason we bring that up is not just for fun. It's that we're going back to see things in the 80s when interest rates were very volatile. And another stat that came was that gold had the best first half to 25 since 1974, I believe. So we're seeing markets flash and do things it hasn't done in decades. And yet we're like, hey, equity markets are up. And what we're going to say here is that equity markets are not the signal, it's rate markets. And the second thing is we are one water table globally. And the Trump administration is engendering or taking on new policy that is spilling over across regions, and it's going to have blowback. So there's going to be a lot of volatility. And with that, I'm going to share my screen, and we're going to talk about rates for 2 or 3 minutes, as I promised Bill. And then we're going to be jumping into some how it's impacting markets. So here we go. Hopefully, all right. So Charlie, you go on. I'm going to go pop back on Chrome, Bill, because guess what I did again? I entered the wrong browser.
You didn't have to admit that. I knew
You
what
go.
happened.
I'm bouncing. You guys keep rolling. Charlie.
Yeah,
interest rates.
I had a question for you, Bill. So on the jobs number, obviously we see a spike when this big change happens. I mean, it's whatever it is, the lowest number of new jobs added, and what was it, a negative actual net change. So we have that, and then the classic thing is that's like a big conversation right now in the data part is the revisions, and they're not actually being that much oversight really on the data coming in, and it's the classic case of bad data in, bad data out. And so the question that I have is, are the markets reacting later down the line when the revised metrics come out and they're actually closer to the truth, whatever the amount is that's changed? Or is it just, no, we just take it as the reaction to the numbers on the ground and then we just forget about it? Like, I guess when you make anyone who has a forecast, they never really look back and check whether they were right or not.
Yeah, so macro data is a bit unique in that, you know, there's almost expected revisions, and these things are unreliable all the time, and no one really gets too upset about it. So it's maybe doubly important for, you know, macro data to have a true point in time feature, so you don't look ahead. So like, just to illustrate what could happen is if you restate these numbers and then you start doing a model historically, and you looked at this past week, it would look like bad job numbers, right? But everyone thought they were good job numbers for the previous month or more. And that's not getting into the nuances of your question about like, how do they trust these? It's like, literally, if you just looked at the data, you would be like, oh, it looks like a bad outlook starting in, you know, July, August. But we didn't actually find out about that until the first week of September. So look ahead bias in that case could, you know, totally throw your models off. And you can imagine if it's like an interest rate model or something, like it literally changed the probability of, you know, a material change in interest rates. So you're, you know, if you're aligning yields with this news, it would just be way off. And then you would look at that and you'd say, oh, that looks like a significant thing. But no, it you know, hopefully if the market actually knows what it's doing, it'll kind of like laugh at these jobs numbers when they first came out and say, no, those are wrong. And sort of pricing in the chances of the yield curve, like, will sort of reflect reality. And so I think it is interesting to look at revisions in economic data and see, like, did the market actually price this in? And then you can have some interesting potential alpha opportunities. But you know, I guess what is interesting is the economic reality would be revised. The uneconomic, like fake reality, is the one that is originally out there and then subsequently revised. I don't know.
It's interesting because if you can get a baseline to the true number by taking whatever other data sources that are out there, that which are, let's say, a lot more live than whatever the actual government's using, then you could find whatever the difference is and see, okay, here's the amount to which it's actually being taken into account, all the revisions or whatever it is, or the difference. And so you can say, okay, I need to add this as a sort of buffer between my number
Scalar.
and what the market's actually going to do. Yeah, a scalar.
Yeah.
Yeah. And there can certainly be like confidence intervals around that just based on how often and how much. And then, yeah, interestingly, we've actually on this podcast talked about now casting and some of these other things that are more recent and valuable. But even those can have pretty big revisions, right, Mark?
Yep. Yeah. And it is like a waiting. I use the word scalar because I kind of caught on what you were asking there, Charlie, and people were complaining about revisions. If you just look at the pattern of the announcements, you could have create your own scalar and say, whatever they say, I'm going to have a scalar that also may have a sign difference, but forget a dampening or amplifying component to it. And obviously that bore out because going into the July unemployment number, not this most recent one for August announced in September, but the July number announced in August, they took out a third of all the jobs created over the past 12 months. They said, yeah, May and June, we were off a little bit. So I don't know how in the model you account for the person who provides the BLS data being fired subsequent to that August release. You think they're going to change their process? Probably. So maybe they changed it and they said, you know what, we're doing it wrong. And then all of a sudden there was an under report. Maybe that had to do with a change in the system. So how do you account for that? On the jobs number, you have to almost discount the number because they have a regime shift in the office. They had a change of leadership and probably modeling. It's crazy. So that's why. Go ahead. Sorry.
I will continue trusting the government about everything.
I think their incentives are aligned. I'm in. So that's why we're pulling up here. If we, as a risk manager looking at stuff, especially post 08, I was noticing how, hedge funds had a tough time making money, and they would make it like the escalator on the way up, and then the elevator shaft on the way down, they would lose it with a rotation. And it was most always an interest rate related rotation. There was a shock, Fed came in, dampened it through inaction, rates would spike, come down, rinse and repeat. So the interest rate side, and then we won't go into the thesis about why that's happening. But for anyone who's not that familiar with rates and is an equity, vol junkie or gamma, option gamma monkey, just focusing in the narrow, we invite you to look a little broader. So here we have the 1-year graph of the VIX, which is the volatilities of a strip 1 month out of the S&P 500. I think it's a top 50 trading largest in the S&P 500. Basically, it's an implied vol, what people think the volatility, the price chop will be. As we know, of course, it went up at the tariff tantrum in April, came back down, bumped along. It's in the bottom quartile, easily. Look here at the U.S. interest rate volatility. It's the Treasury futures, and it's their volatility, the whole curve, not just 1 point, but the whole curve. So it takes in rotations or inversions and the like. And guess what happened in September of last year when the Fed cut? The market didn't like it that much. The long end went up, and there was a basically, they call them the bond vigilantes. So you had a very different reaction here in equities, huge reaction here on a relative basis in interest rates. And here you have it again. You've had it in around the Jackson Hole, pardon me, escaped me. The Jackson Hole speech when he went dovish, and everyone's like, oh, are we going to have another redux where we're going to have interest rates go down the front end? And everyone's like, hey guys, if you do that, it's inflationary and the back end goes up and interest rate costs will go up. So just be curious. The world doesn't fund itself in equities. The world funds itself in rates, and rates are volatile, they're uncertain, and with a debt load 2x what it was 20 years ago, it's costly. So that's the thing, is we think interest rates are a much bigger factor when it comes to looking at broad market volatility. So I'm going to go through this one. This just shows you that the MOVE index over the last 20 years hasn't come down since COVID, really. The VIX is down here in relative terms. It's back down. The MOVE index, again, the same thing we saw earlier about interest rate volatility, hasn't come down. And again, spiked up recently. So that's why we think it's relevant.
Why do you think that the regime changed with COVID there? You know, MOVE index hasn't come down since.
The supply of money, because the US printed 40% of our total money supply in 2 years. So 240 years to get to, I don't know, 16 trillion or 15 trillion. And then we did an additional 6 trillion, something like that in 2 years. So it was a bit of the market walking away being, wow, how are you going to digest this and pay for this? So we're focused on the price of money because the supply is so far off the scales that market barometer is volatile and can't, people are, that the price of money in the long end is, where the Fed doesn't control, is going up and down like a yo-yo.
It was actually double the amount as well, Mark. It was 80% of all dollars in circulation were printed during COVID.
80%.
So even higher.
Right.
Yeah.
It was 40% a year or something like that.
Mm-hmm.
Yeah. Thank you for that, Charlie. So
All
this
good.
is why you want Quanted. They set you straight real fast. No fake news here on the podcast.
Just helping him
Totally.
just really solidify that point.
That's it. And
That's
now,
it.
now look at this. We do year over year, talk about like one water table, how you can stay in your narrow channel as a trader and think that you're orthogonal. You know, you're orthogonal until you're not on your, you know, your risk you think is balkanized. In last September, you had inverted yield curves for the US, Great Britain, and Germany. Japan had the only positive sloping one. It's changed as inflation sets in. And Bill, on that, you know, recent jobs number, our new analyst at Risk Dimensions we have imported from Austria. Yes, he's an Austrian economist by training. That's why he's a Bitcoiner. But let's not go off piste. He brought up the fact that globally there was a total bifurcation. You had PMI numbers, which are like, hey, what do companies think what's going on? They're like, okay, it's kind of average PMIs, plus 50, you know, plus 1, minus 1 over 50. 51 means growth, 49 means contraction. They were moderated around that, but with a huge gap. Prices were higher at 70, and growth or employment were lower at like 42. So all the data is pointing to higher prices. So that's why I think when we have this rate cut, we haven't digested what will happen on the rate side. And we all know that when rates go up, markets go sideways. So now I'm going to finish up here and go back. Globally, markets and investors are listening. Gold is up 38% in the year. Month to date in September, it's up 5.4. Bitcoin's number 2 at 4.1 across all global assets. And for the first time in years, we're seeing a rally here in the 20-year, the TLT ETF. That is every punter's favorite ETF to trade, the long end treasury, up almost 4% on the month. And it is, you know, only up 6% on the year. So the majority of its moved come recently. So there's more to come. And, I'm trying to think what else. You already went over the factor stuff. Here's the concern. The U.S., as Charlie said, has printed a load of debt in the last couple of years. 25% of their tax and all income goes to paying interest expense. We can't afford it. So they're going to try to lower the front end and only issue T-bills. So they are paying lower rates on the front end. The long end is making them pay more money. Every 10-year that rolls off, Charlie and Bill, is going to be funded as a treasury bill at the next auction. They're not going to be issuing. We're going to be basically a front-loaded treasury curve or amortization schedule. And if you want to look at a poor company, a good company has a pushed out liability structure. A poor company isn't able to fund at 10 years, 5 years. They can only fund overnight and secured. That's the way the US is going. They can only be front end, short-term debt. And that's why the T-bills are going up. And that's why the stablecoin legislation went through, because it creates new buyers of treasury bills. Because all stablecoins in the US have to be backed by treasury bills. So this is a concerted effort to address the growing debt load, but it doesn't mean long interest rates are going to be any less volatile. So back to like factor rotations and getting even more attuned on your process, like what you guys afford people, Charlie. Everything tells me that. And I'll finish on this credit slide. Interest rate volatility is still in the middling of a 30-year look back. It's not lower like equity vol is, but credit spreads are. So there's basically all the corporations are able to fund themselves pretty cheaply now. At 81 basis points, a high yield company pays less than 100 basis points over an investment grade company to fund. There's a huge demand for credit still. So there's a wash in dollars. The only other time it's been this low is before COVID, didn't end with smiles, before the 08 crisis, and then going back to the 90s before the Russian default crisis, long-term capital. So that's the setup. So invest wisely, my friends.
And before we jump in with Charlie, I did get a question following my use of the term crappy stocks. What are those? And I think that the slide that Mark just showed illustrates what are typically going to be the same thing, if not just overlapping a lot. So companies with a lot of debt that could actually blow up and go bankrupt would be what I affectionately call crappy stocks. So, risky would be another way to think about it. But, basically the risk that your equity will be worthless, because if a company defaults, basically the bondholders take over the company and probably taking it through bankruptcy, and also lose significantly. But yeah, the easiest way to define a bad company would be lots of debt that they will struggle to pay off. It could also just be deteriorating fundamentals. So think about Blockbuster renting VHS cassettes when streaming came along. So that would have been also a crappy investment to make at that point. And those are very popular investments, as Mark just showed us. The other reason why bond spreads are down so low is because there is a lot of interest in buying companies with a lot of debt and risk. And that's also just a function of government policy as well. So pumping the system full of cash drives people into riskier investments.
Makes sense. If you go back to that chart, Mark, obviously I wasn't of working age living through some of the previous crises, but I guess the question that I had for you both is just what is the same and what is different about the overall sort of economy right now, economy, government, whatever it is, between this cycle that we're in and these 3 other cycles that you identified as well? Because I think, Bill, we've maybe discussed it before about this whole dollar dominance and what's going on there. And I guess the thing that we said was, okay, if you assume that you can consider what's happening to be cancer to the US economy, the dollar destabilization being pushed out, whatever else, by the BRICS economies, if it does happen, and that this big push by the administration is akin to, let's call it chemotherapy, and you get 2 shots at chemo before all of this runs out, because like you said, Mark, you end up having too much short-term debt that you need to pay back, and you're no longer considered a really viable creditor. So I guess that's the question, is what are you seeing that's the same and what's different between this regime that we're in right now and these other ones that were going on before? Obviously right now we're in like this AI super cycle, which I guess they're using to excuse it as well by saying, oh, we can do all of this because expectation is techno optimists. We're going to go all the way through. AI is going to be competing mostly from the US, and we're going to get a huge push on GDP growth as a result of that. That's going to dissuade all of these other things. And AI is largely a deflationary thing in general. So I guess that's the question, or from their opinion, either way.
All right. I'll try to do this in 90 seconds. As Bill knows, I put a lot of hurdles in front of me and never make them.
Okay.
I still owe you $200, Bill, as we know. So I'll do 3 periods. We said the 90s, long-term capital Russia, 08 was the global financial crisis, and we have today. I'm using debt, and then I'll use one other graph. In 97, 98, when we were a few years out of recession, there was risk-seeking behavior. There was a lot of leverage in the system, which often happens in late stage in cycles. People are feeling good. They buy the crappy companies that Bill mentioned because they don't look at the debt. They look at the upside and the opportunity. So it's a bias. It's a recency bias. Things are going great. They'll keep going great. Long-term capital came along. They said, hey, listen, we're making money. Let's keep leveraging. It was a Greenwich-based firm. I was 3 blocks away from them. I was at a brokerage firm. They wouldn't even return our calls because they were flying so high. We were a smaller brokerage firm. They went under because they kept pressing debt. Like a crappy company, they were a crappy hedge fund. When they failed, the Fed invited them on a Sunday morning to come. You can say it was compelling them, but the Fed didn't control the balance sheet. So the companies, long-term capital was, the banks that gave the long-term capital money were invited to the Fed, and they were told, keep extending the money and have them unwind their book. So the banks were in control in 97, in 98 to unwind long-term capital. A series of corporate bankruptcies followed that late stage cycle. Companies like Enron eventually went out of business. It was WorldCom, right, went out of business. That was the unwind of that bubble. So companies went out of business. Banks were part of it. They extended, they walked away. Then there was another risk seeking. That was the first period when we had low credit like this. The second one was 08. The banks weren't invited to do anything. They were taken over. Because you couldn't have a corporation, you can have a corporation go bankrupt, you can't have a bank go bankrupt. 97, 98 was an old-time bloodletting into 02. Bankruptcy works, bad capital out, good capital in, off to the races. 08 stopped that cycle from happening ever again because the government was now on the hook. They lent their money. They were on the hook. They are now in the banks on the 3rd floor of every banking headquarters in the United States. They are effectively taking over the banking system. They have issued more debt in order to support it. They can't go bankrupt. So what's different now in this cycle of credit is that everyone's emboldened because they say we're never going to have a recession anymore, because if there's a problem, the government might go down with it. So Charlie, that is the kicking the can down the road type of
on the kicking the can down the road as well. So it also makes, every time that I see that chart of the cycles and where they're happening, you obviously run into this most recent 2 cycles, and if you say that we're in one now and COVID was another one, they're a lot more compressed than historically. It's like 10 or 20 years. Now it's 3 to 5. So do you see this as the time in between cycles is compressing, and maybe that's something to do with Ray Dalio's sort of end of very big cycles sort of thing? Or do you see it as we actually never left the COVID cycle, we just had some sort of synthetic growth come out the back of it because of pumping dollars into the economy or something else, and it's still the same cycle?
I think this, and I don't know, Bill has a different idea because he was front and center in '08, pretty close to some of the credit dynamics. I was at a hedge fund and just watched people walk away and not even know where our collateral was or where our treasury bills were that we had at Morgan Stanley. The cycles, and let's define the cycle. Credit cycles are compressed because we can't afford unfettered bankruptcies. They may try to walk in and walk down certain entities. We'll see how much control comes in that standpoint. Or they may fund others like Intel by taking a 10% equity stake. But default cycles and recessions are being pushed out, Charlie. So you're having a compression of vol spikes, as you said, every 2 to 3 years, like we had in March of 23 with the banks going out. The Fed then created new programs to quell that. In 24, we had, Japan having its worst one-day return since Black Monday. And, we had some relief there in dollar swaps. But you didn't have defaults. So on the recession side, productivity is going to help companies. But the problem is, how do you keep people employed and have wages that meet this rising price structure, asset prices, homes? That's the needle I don't think the government's going to be able to thread. And that's causing unrest and distortion and discontent broadly, as that wage dollar, you're not being more productive as a worker. Your corporation is.
Yeah, I mean, I don't really buy into the whole everyone is going to be super happy and we're all going to have AI just doing everything nicely. I already see it on the ground. Companies hire less. Like startups all the way up. Everyone that pulled off a lot of people during that post-COVID boom, they're not hiring them back, and they're actually saying we're going to keep shrinking. Like you see, Palantir says, what was it, in 5 years or 10 years, we're going to double the stock value, but we're going to reduce the headcount. So it's that sort of thing. Is I don't see a way that this keeps going unless you just see, okay, well, now everyone can start their own business and do all of these things, and so everyone is working in smaller pods of teams. Generally might be good, but I can't really see that works that well either. I think we already see it. I mean, I've got a friend from Indonesia, and he was sending me all of the stuff from over there, and I was thinking, well, this is the start of what's probably going to be, I don't know, 20 or 30 years from now, when no one either has a job or has anything fulfilling to do because they're just stuck on universal basic income or something. Yeah, I mean, I'm not too sure. I don't know if this jobs number actually plays into that, or if it's just a weird blip that's going to be revised because of what you said, the OBL, or what was it, Office of Bureau Labor Statistics?
Yeah, the BLS.
Yep. Person, yeah, got changed. So yeah, we'll see. Anyway,
so I did have
Rose.
a few thoughts on this discussion's going in a few different directions, which is great. But I will also just bring up a few things from what Mark spoke about, like long-term capital management. As we older people, thank you for reminding us that you're a whippersnapper, Charlie. But there's a book called When Genius Failed that describes that, and that was again required reading for me as I went into my like risk management career as well. And there again, it was like the real risk isn't typically credit, it's liquidity risk. And they basically had too much leverage and they couldn't post collateral when the market went against them for a few days, weeks, months. Again, those were all good bets. They were good arbitrages, but they couldn't post the collateral to survive, to collect their profits, just like my former employer, AIG. And so I think what's also happened is we just don't have credit cycles. You used to have boom and then bust, and then a bunch of companies that were crappy would go out of business. They would go through bankruptcy, and then if it was still a decent market for something that they had, that they could actually emerge from bankruptcy and continue as a going concern and stuff. Now, and this started in '08, companies either don't go bankrupt or they go bankrupt with the government's help. And there's just there are no credit cycles anymore. And I think that there's an implicit government put on, banks certainly, but also on, corporate bonds, because once, times start getting tough, like we had our news last week, the government's gonna come in and lower rates and help rescue the system, which includes companies that issue high yield debt. And so I'm not sure. I even like vol spike. I'm not sure like what the ultimate economic outcome of those things are. Some people make money, some people lose money. It's a zero-sum game in Wall Street, but like nothing happened as far as COVID didn't cause a lot of defaults, even though the entire economy shut down. The recession, quote unquote, was like what, 1 month, 1 quarter at the most.
Yeah.
I don't think it was because everyone was just sat on a load of dry powder from pre-COVID, all the ZERP money that they were just sat on. So there was nothing really to default with. They had stuff, and now we're seeing that come to fruition. It's now 4 years later, all the capital reserves are running dry, and there's more bankruptcies at the start of this year than there has been for like half a decade or something.
Yes, Charlie, that's there are more bankruptcies happening. Unfortunately, it's the smaller firms.
Yeah, but I think that's typically what I would be expecting, is that I think it's quite a few of these like growth companies who are still in private markets that are going bankrupt, and then they obviously just raised huge amounts and then got swept under by, well, it was a bit of a rug pull because AI came out and they were too technically involved in whatever they were doing to be able to actually adapt. Or it was these other companies that, I don't know, there was a few like physical stores, like I guess Forever 21 and things like that, where I don't know, I don't know what that is. Maybe it's just the zeitgeist changed and people don't want to shop there anymore or something, but that's an American culture thing. I wouldn't be able to
Bill
tell
and
you.
I don't.
You don't shop at Forever 21. Okay.
Anymore.
But I also like how we brought up Palantir. So in Mark's recent Substack, he described Quanted as Amazon meets Palantir, which I think is a great compliment to Quanted. And we've described it earlier on this podcast, so perhaps some people understand, but Quanted is also known as a data bridge, which to me really just means Quanted helps primarily investors, but presumably anyone that wants to consume data and pull it into a predictive model. They help you ingest and analyze data, which in the machine learning world we refer to as features. And so Quanted is basically a feature platform that easily allows one to explore a bunch of different predictive data and features to add to their model. And so in my world and in quant finance, that's a pretty clear value proposition, because I can start exploring, okay, what data is out there that may add value to my process, and I can hook up with Quanted and do some testing and hopefully find some vendors that sell data that looks valuable to me. Quanted sort of plays matchmaker between myself, the quant fund, and the vendor. And that's the business model. I guess correct me if I'm wrong with that summary, Charlie, and then feel free to elaborate on that and explain how it is Amazon meets Palantir.
Yeah, I mean, it was pretty accurate. I think the main thing is just it's this marketplace that exists, and there's people who produce data and people who utilize data. And on the utilization front, you could theoretically have anyone. You could have anyone who's doing a forecast or needs something to use that data for, which could be a civilian, could be a business. But in our case, we're looking at finance because they're the people who are doing the most predictions, and their predictions normally have the highest leverage put on them. So yeah, what that really means is that there's a load of data out there that could potentially be predictive. The issue is normally how it's packaged. So it's either wrapped up pretty poorly within some huge product, of which there's a load of barriers to entry, whether it's cost because the unit economics aren't great because there's not that many buyers, mainly because of the data science that's required to do it. So you have to have these big firms with big data science teams or quants who are able to actually pass through all of that. Then two is just the fact that it's normally not collected that well. Like most time, this data is coming at the very source by accident. It will be a byproduct from what a company is doing. Then for the rest of the stuff that is normally sort of bread and butter, what's on the market, it's something where someone's been very diligent and purposefully gone and set about the collection and maintenance of this data. So it's typically where you see this sort of disparity in the market. You'll see real data producers who are normally just companies, could be Visa, MasterCard, the person who Square, whoever it is, who makes the thing that is collecting data as a byproduct of everyday usage. And then you've got these other companies who are really aggregating that thing, and they've gone out there with the pure intent of, I need to go collect data and I need to format it and collect it nicely for finance. The only issue is there's not been enough growth of these sort of middleware players compared to the growth in the actual data stack at the top. So people now struggle to get past this sort of group of, let's call it like 60 to 80 really established bread and butter data vendors who everyone knows and everyone has, and doesn't matter what firm you walk into, you're probably going to have most of them already by the time you get there. And it's this question of, okay, now we've got all of these others who are either new or their business is trying to monetize their data out, exhaust, or whatever it is. And the questions start with, okay, what's the legal and compliance here? Is it good? Second is, okay, is the data actually technically good enough? Does it have a long enough history? Is it point in time? Have they been making revisions? Do they do any calculations on their own, or is it as raw as it can get? There's these sorts of questions. And then it gets to the real, okay, can we actually test this and find something useful? All of that just ends up being a huge waste of time for most people, because you actually only converse on, I think we've spoken to well over 100 funds, and the best will test 100 to 120 data sets per year. The big New York firm that has many little firms underneath it does 350, and they're far and away the best at testing any data sets. And then the conversion rate is typically like 20% for any of them. Doesn't really make a difference. It's almost always around 20%. It can be lower, can be a little bit higher. Some pods are better and their conversion rates can be 50, but they'll only test 3 things a year, so it doesn't really count. That's really it. So what we've gone out to do is essentially help the vendors stop wasting time on sales that don't make sense and they're not going to go through, and stop the quants and traders generally wasting time on data testing that isn't going to go anywhere either. So before either of them engage each other, we just sit there as a centralized platform where we say, we've already got all of the data. We already did the first things that you were going to do: ingestion, cleaning, feature engineering. It's all sat there, and you, as the trader, quant, data scientist, whoever, can come to the platform, make a query of the entire data set before ever seeing it, before ever engaging a vendor, ever doing any legal and compliance. And you will be able to say whether or not this data potentially has value to you. Then at that point, you know if it's worth the effort of doing everything else. So we're trying to convert that maybe 100 data sets tested per year with a 20% conversion rate. We'd rather you test 1,000 potentially and know that the ones that you actually take after that, you're going to have a 50% conversion rate. You might only actually take 20 out of the 1,000, but on those, you should convert way higher. That's the main goal. Yeah, there was a lot of talking there. Sorry.
It is, having been involved in the data side for a spell when I was at Credit Suisse, sharing sentiment data that was anonymized, aggregated, anonymized. I have a little bit of a window into the processes and how long it takes and the teams involved. So when we had David on, he told me about the collapse in time and the efficiency pickup. I almost thought of it as some of those teams wouldn't even want to speak to you because they're like, I'm going to have to fire half my staff. And some people like having staff. Like, do you see a problem where you have to find the right person because you're so efficient it can scare the bejeebus out of the team? Or am I just making hay out of that?
No, I think a lot of the jobs that the people are doing, they don't like doing. So it's okay, can we actually spend this time doing more interesting things than what is essentially like checking DDQs and like doing stuff that, especially, I think if you were doing something you didn't enjoy, and at the end of the year you said, I spent 40% of my time doing this thing I didn't enjoy, and 80% of those cases it was completely meaningless, it doesn't really add that much fulfillment to your life. So I think if at the end of the year you can say, I actually didn't have to do the thing I don't enjoy at all, and of the maybe 3 or 4 times that I did have to do it, it was worth something. Like, it then went on to be traded and we made a lot of money off of it, and I got a nice tidy bonus at the end of the year. So yeah, that's how I think about it.
So kind of like Milton from Office Space, you want to go to a higher, better purpose so that you don't end up going back to our Substack post about how to have a more meaningful, productive job so you're not on the wrong side of an employment report.
Yeah, something along those lines. Exactly
Okay.
that. And in terms of I think you mentioned the Palantir thing. I don't know that anyone really knows how Palantir works. I feel like that's part of their mystique and what they do. But I always just think of it as sort of like a healthy virus that comes into your company and just finds its way and weeds into everything. And then at the end of it, it tells you exactly what you need to do, and it brings all the insights back into the centralized place. I would not say that we are that yet, mostly because hedge funds don't want you virusing your way through all of their secret documents and IP that's making them a lot of money. But it is somewhere where we intend to get closer to. So with the vendors, for example, what we're releasing in the next couple of weeks is a lot more of an automated pipeline for getting them on board. So right now it takes us 3 to 4 weeks for a single vendor to onboard them, and that is mostly just because we're having to do a lot of research about it and make sure that the way that they're collecting the data is correct, and then the way that we're going to manipulate it as a result is relevant and is actually providing some sort of predictive insight of something. Whereas we have now converted all of that expert knowledge into AI agents who, upon receiving the data sample dictionary, first agent provides context, describes what's going on, provides it to a second agent. These are all siloed to make sure that data is protected. And these agents can then go out and search the web for specific research that's being published about all of these different things, can come back, reason within themselves and against the original data what's going on, and then apply those changes and say, okay, the data actually looks like this. Research has been found that suggests this would be beneficial. And so here's some code that can then be used to engineer this data to turn into this special predictive insight or features, whatever they are. And essentially that can take the entire process of 3 to 4 weeks, human in the loop the entire way, to 1 to 2 days, run it overnight, and just have human checks that are doing spot checks to make sure that what it's doing is actually correct. Obviously, the big question that comes up with that is, how are you avoiding hallucinations? Are you making sure that it's all still relevant? That's where the human in the loop comes in. And obviously we've translated whatever is 10,000 hours of expert knowledge on this into, I think it's taken 5 months to develop. So we'd hope that it works well. I think, Bill, you've seen a couple of the initial outputs. And yeah, I mean, that's sort of the first version of Palantir 2.0 in Quanted, is do it on the data side. And then on the quant side, I can talk about it after, actually. Maybe, Bill, how did you think of the outputs that you saw from the agent so far?
Yeah, so I think it's always interesting when we have these new comparisons such as Palantir, and when I think about Palantir, I think about it, you know, a massive data repository that's, you know, been organized from the beginning, but also is reorganized, and sort of, you know, the metadatabase around data is often starts off with what's called a taxonomy, and then
Mhm.
you know, a taxonomy of taxonomies can be called an ontology, and rather than get into these fancy words, it's just you know, the system can learn about things that, you know, humans don't easily observe, um, and it can make connections, you know, beyond statistics and like correlations between different data sets and things like that. So when I looked at David's most recent version of this, I saw, okay, we have these features that are now described with a lot of detail. And it's detailed information that I, as a quant, care about. So, how can you use this feature? What's a hypothesis for a way to test this? Like that. That's incredibly valuable to um, like a statistician who, or you know, a quantitative researcher who is trying to do econometric um, testing, and so getting a hypothesis coming along with your data obviously has a lot of value, because now you can actually, you know, start coming up with, you know, changes and have your own human in the loop um, involved in finding a new and novel way to use a piece of data to forecast stock prices. Um, and so I think that as you get the feedback loop going with the predictive nature of this data, and you know, I know I'm getting ahead of ourselves with what Quanted has now and what it will have in the future, but I think it will be incredibly valuable to have this feedback loop, this mechanism running that says, yeah, we've done some of our own work. We actually can prove that this type of data is predictive of this, um, you know, stock information that is important in the forecast of a stock price. And then eventually, you know, a lot of the like nonlinear um, things that are harder to observe will also become available to Quanted and its customers. So I'm very excited about someone like another company solely focusing on this area, because large quant funds, you know, try and focus some of their attention on this one area, and it's not enough. It's you know, tech debt and other reasons. You know, there are a bunch of reasons why there's always a competitive advantage to being really good at like one thing, one area. um, and I think you'll ultimately just be way better than anyone else is at onboarding data, deriving insights from it, and then presenting it to a quantitative process.
That's what we'd hope. I think the one thing that we've noticed is like all hedge funds are probably a lot more similar than they are different, is one of the main things that we see when talking to all of them. And it's typically this aspect around like the operations that are going on within. So you get a couple different types. Obviously, you've got the big multi-managers, you've got like a pure quant shop, you've got maybe a smaller, less pod develops, it's more like managed top down by the head of research sort of thing. But generally the processes that they're doing are all roughly the same or on somewhere along this evolutionary timescale of the same thing. And so it's just a matter of trying to externalize as much of that as possible and then see what we can do with the added access that we have to data that they potentially don't. So where we can see all of the data in the world and we don't need a business case to onboard it, we just need, okay, does it meet technical specs? Good enough for us, let's get it in. And obviously the DDQ has to be passed, no MNPI and whatever else. But as long as that's in, there's a lot more that you can do with it once you have absolutely everything there versus what they're dealing with, which is we need a business case. It needs to go through legal and compliance. We're now 6 months in, and the person who wanted to test it can't be bothered to test it anymore because something more interesting came up. It's these sorts of things that we've seen get in the way a lot. So long as you can really pull out, let's say, all of the operational parts that were less interesting to them, put it in one place, and then just allow them to do all of the testing that they want to allow against a much larger scale of data, that's what we care about the most. I think that's a bit that you touched on as well with the metadata. Is something that we're seeing is obviously very trendy, very much the zeitgeist, and for good reason, is this agent access to all of this stuff. And historically, not great for this sort of data. Firstly, the actual vendors themselves don't want an agent looking at the data. They don't want any LLM actually processing the data that's going to be connected to any cloud, which it has to be if it's a reasoning model, because there's some possibility of data leakage. So for us, contractually, we're not allowed to do that, which is why we have these sort of on-prem agents that we run locally that are all sort of modularized and siloed. But then you have the other question of, okay, how, as a hedge fund, do I utilize agents because they do have this very high automation aspect that's going to improve the performance of the fund, or at least the productivity? So how do I actually utilize them, knowing that I'm not allowed to utilize them on data a lot of the time, like on the raw numbers themselves? And the answer is the metadata that surrounds them. So long as you can realistically call it labeling, label the data incredibly well with a lot of granularity, and enrich it with a lot of other sources, be that published research or other data, or the case studies that come from the vendor in the first place, their white paper, whatever it is. With that, you're then able to do a lot more with the agents. So our goal is really to allow, could be a fundamental analyst, could be a quant in the first stages of their thesis development, essentially to query the entire database based on the meta labeling, or sorry, the metadata. Meta labeling is part of our other products. So based on the metadata, query the entire thing, saying something like, I have a thesis, natural disasters are going to keep occurring on the coast of the United States. Find me any data that relates to this and is high linear correlation to house prices in California and Florida, something along those lines. And the system will then use cosine similarities to find the connection between the actual features and the query, and then it will use linear correlations to find, obviously, the correlation between the data that it's found as the output and the input target that the user put in. So for this case, house prices in those two places. It's that sort of stuff. At the end, though, that isn't even enough. I think in the long term, you realistically want to be able to just set an agent with one condition that it has to meet. You just say, okay, here's what we're maximizing for. Now run this on repeat and just keep going. And all it does is it just keeps running until it gets the outputs. Maybe it will edit some of the bits along the way, like what are the modules I'm going to be using for analysis. It's not just going to be linear correlation. Is it clustering? Am I doing some mapping to check that things are moving together? Whatever it is. And then it says, okay, at the end, were my conditions met? Yes or no? Okay, let's ideate and go back to the start. We connect it back up to our featureization engine, and it can say, okay, I tried to do this. This was the output I was looking for. Didn't happen. It might be able to happen if other feature could be created. Is this possible with the data that exists? And then the featureization engine can go back down, create new features on the fly, put them back into the system, and run it again. And you have a human trying to do this, it's going to take you weeks, months to keep going through all of these cycles, especially assuming Quanted doesn't exist. You have a human with Quanted, they can do it in days, weeks, minutes, whatever it is. And then you have a human with Quanted and the agentic orchestration layer on top, and that thing can run thousands in weeks and give you all of the outputs and just tell you, okay, here's what would have taken you 5 years to do, and I've done it in 2 weeks, and here's the output. Would you like to see it, and would you like to trade it? And then obviously that's for them to do. They've got to go buy the data and do the execution and set up the models. But yeah, that's the sort of real end goal. I don't know, Bill, how much that aligns with what you're seeing on the ground and sort of all the new hedge funds you see popping up.
So automation is always very valuable, especially in this space. And it's not just time, it's also the opportunity cost of, like, again, people working on things that they want to work on. There's like real attrition that comes along with some of this stuff that is quite frankly really boring and it's not rewarding. But what you're sort of talking about in the future is an agentic AI driven investment process, um, a lot of which can be automated. So again, like the information that you would extract from the entire research process will be kind of served up to a human in a nice package, and it will look better than the one that humans created with all of the months and years of work. And eventually, like the PM, a lot of their thought process can be embedded in a machine's logic. um and so I think we are moving uh eventually to more of a like a robo investor process, and maybe someday um a lot of investing will be done that way. Like humans just can't do a much better job, and like passive investing um will evolve into more of an active thing, but you have a machine doing some of the active allocations for you. um and so on the ground, I think if you were setting up a hedge fund today, you should use all of these super powerful tools that have enabled the entire process, the entire research process, which, ideation is one pretty big aspect. And it used to be like, okay, think of the idea in your head, read a book, read a paper, talk to someone. And then eventually you say, okay, what kind of data can I use to implement this idea? What kind of data could help me predict the thing I'm trying to predict, which is, in my case, stock prices. All right, now I'm going to search for that. Once I find it, we have to onboard it. We have to get legal compliance. There's just this huge lead time that has been compressed to nothing now. Um, and so I think that ideation to feature construction to feature ingestion and a model that quickly gives you feedback and tells you if this is profitable not or not is just compressing down so much that the speed with which you go through the whole thing will actually be the edge for a time, and then eventually I think a lot of this just gets more and more automated. So I find it super compelling to not necessarily outsource the data discovery and data management process, but yeah, I would rather buy this than build it. So um, hopefully emerging managers in the quant space will recognize the value of this. And then I think as a lot of the fundamental and discretionary investors are becoming more, quantamental being one of the buzzwords, or more quantitative in their research process, will also find something like this really valuable because it gives you, again, the hypothesis and the sort of intuition around why certain data will be helpful and predictive to your process. So if I was a sector analyst, I would probably want to go here and say, like, what kind of data can I use to get better at predicting the price of Palantir, or you name the tech stock.
Yeah.
And
One of the questions that I had for you is, so one of the ones that we get, and Mark, feel free to throw in your opinion here as well, from investors when we're raising historically or prior to the last round, was, okay, if you're helping everyone get so much more granularity and visibility over what's going on, does that not create some mean reversion, or essentially efficient markets hypothesis starts coming into play because you have all of these, let's say, Bill's final end place is that there's these robo investors who end up sort of mimicry doing the same thing. How do you guys see that?
From the cheap seats, I'd say that process has always evolved. ETL used to be an edge, how fast you could extract, transfer, and load. And then one large hedge fund ended up commoditizing it and selling off their ETL process to others who weren't there. So if you're not doing this you're just the first person to provide what is inevitable. So what you're providing people is a way to accelerate their process, in Bill's words, which I've adopted, is to their higher, better purpose. Like you said, folks aren't averse to this. They realize it's going to make them higher, better. And all it does is it compresses the time frame to exiting the marketplace. Because with this new process, it gets you there. It gets everyone faster to achieve what they can achieve with their internal alphas. So that's all I think it does. Is it then allows for a faster culling of the marketplace, and it lets the better be even better. So I don't think it creates a mean reversion of everyone's going to find it. That statement assumes that we've found everything. We all found everything, and all I need is this to be the best. I mean,
I never liked it when I heard it from investors.
Yeah.
They just always asked it.
And
I
I'll
think
think of a better
largely
answer that's
non-economists,
heuristic
but
about the that deals with heuristics and bias. But that question eliminates a lot. It excludes. It makes a lot of assumptions that all you need is this, and then the field flattens. And that's never been the case.
Yeah.
But Bill's been on that side longer and more than I have.
So I'm glad, first of all, that you brought up the startup journey too. So some of this came from, I believe you mentioned, questions that investors and Quanted have about like the value proposition for your business model. And since we're wrapping up in the next like 5 minutes, I would like to make sure we cover some of the startup journey that you've gone through over the last year, which includes, I think, convincing investors that this is a worthwhile endeavor. The reason why Debbie and I believed in Quanted is we were, very familiar with this thorn in our side, and Debbie used to get humans to key data into spreadsheets that they would send to us as the analyst, because we eventually discovered that it's cheaper to actually pay humans to do things manually rather than have engineers supporting these like parsers and things that would break, when just keeping something simple is the best way to go. So I almost lost my train of thought from where we were going.
I think we were Charlie brought up the fact that everyone does the what about, which is an absolute cancer of a thought process out there that prevents everybody from ever doing anything. What about?
Yeah.
And then we kind of, I think, quasi resolve that. And you, I think, we're focused as we're getting closer to the end to make sure that people understand the opportunity that Charlie's done. What we try to do here is give platforms to companies that are disrupting the larger companies that can't move, can't change. But I don't want to put words in your mouth. I think you were trying to bring those two together.
Yeah, that's right. So the what about question that I think, I mean, these are common, a lot of times basic questions. They would be like, well, what about me? I can onboard data and do this, and why is it so hard? And can't you just onboard a bunch of data and normalize it and make it easy for quants to ingest? And these are fine questions, but in order to answer them, you have to be like painfully aware of the details that make it impossible.
I think one of the things that we've noticed, especially with these sorts of like specifics around the startup journey, how do you decide what to build when you get these whataboutisms and whatever else, is specifically in quant. And I will say it's building on hard mode, because they don't want to speak to you. They don't want to tell you what they want. And you can ask any data vendor who's gone through a test or trial period with a quant. They start they'll send the data, you won't hear from them, and then you might get some feedback later on, or you might get ghosted. Either way, you're not able to help in any way because you have to protect the IP and whatever else. Sorry, I will.
I was probably personally one of the biggest pains in the ass to like a salesperson because, and I'd be like, oh, so and so was looking at it, but now they're busy, so call me back in a month, and these things would just go on and on and on. And now, you don't really have this excuse to blow things off and say like, oh, next month it's like, oh, okay, the data's streaming now.
Yeah, I think the main thing that we learned is just you'll hear little snippets and bits of information from loads of funds, and none of it will make any sense individually. But then you put it all together at the end, and that's where we're lucky to have a Bill and a Debbie and some of our other investors who have really lived the domain for a while. And we come to them with snippets from 40 different conversations that we think are all about the same thing, and they'll say, "Oh yeah, they were just talking about this one thing. Like, here's how you fix it. Here's the exact thing they're talking about. Here's the design idea that you need to think about, and here's product direction that you should be looking at." And it's this sort of disparately connected string of consciousness, if you can call it that, between 40, 50 funds. And like I think I said earlier, a lot of them are more similar than they are different. And I think Bill has seen that, having worked at a few of them, that a lot of it actually, it turns out, is just operationally the same thing, and they're just not allowed to tell you. So I think one of the good things about working in this domain, and I see it in some of the other companies as well. So there's, I think, a few like good ones that I've seen starting up around like Carbon Arc. There's these guys who have just done A16Z as well. I think Oleum and a few others, where it seems like they sort of know the domain pretty well, and as a result can build in it fairly nicely. And then it's a matter of, okay, are you going to really drill down here because it is harder than other places to build, or do you want to explore your other options and try everything? But at the end of the day, the only real way to build anything of use is just you keep asking people what they want. Don't leave the room until they tell you. But I mean, that's sort of what our thesis has been. Unfortunately, with Zoom, you can just press cancel call, but we luckily haven't had too many of those. Yeah.
And so moving into the next phase of Quanted's growth, I'm very excited about what I've seen recently. I think, ultimately having a data lake with all of the world's predictive features will be super valuable. But what's the next phase for Quanted, capital raising, development?
Yeah, so we've got a big relaunch towards the end of this month, start of October, which is going to be on both sides of the marketplace. So we've got the data onboarding agent, which is coming out, that enables us to provide a lot more value to the vendors. So we're going to be giving them a lot of different stuff, from information on what research is that relates to their data, how they can improve data dictionaries for Wall Street, how they can improve their data sampling, collection methodologies, case study directions that they should be looking at, and new actual data that they should be integrating, whether that's new stuff that they can collect or companies they could do M&A for, anything along those lines to improve their product offering. And then on the other side, actually staying on the vendor side, we're also doing white labels now of the new tool. It's this sort of query interface, and that is one of the products that we're developing. I think I mentioned it earlier. So it's just being able to query everything in natural language and then perform sort of linear analyses on those. It's deploying those towards the end of this month, and then really pushing that into the fundamental direction. We're hosting a lunch, we're going to these conferences, we're doing all of this stuff to sort of get the name out there now that we've got these new products coming out. And then we'll run that all through to the end of the year. Got a bit of a road show, so hitting up the main finance hubs in the US and showing them the new products and everything along those lines. And then in Q1, we'll probably look to raise again. We're likely going to go strategics. One thing to note as well, typical VCs don't really understand this domain, largely as a result of, again, the quant funds wanting to keep it all secret. But luckily, the quant funds do have strategic VC arms that they will invest using if they use your product. So anyone building this domain, go look them up. The HFT firms especially, they have a lot of capital going towards this. But yeah, great investors as well. So I hear. That's it really. That's the product direction, company direction. Yeah, the whole shebang. But no, we're really looking forward to it. It's been a long slog, I think, and it's getting to this time where you get to really see the results of all of the hard work that you put in over the last 2 years, and I think that's one of the nicest parts of it. Obviously, we're working with very sort of heavy tail distribution here on terms of the number of things that you try actually coming to fruition. But I mean, it's sort of the startup world, it's the investing world, it's gambling, it's whatever, it's all the worlds that we live in. But yeah, I think it's a nice thing being able to see some of them coming back and showing fruits.
I think Mark's on.
I think you're on mute, Mark.
I think you're going to harvest some of those fat tails over the duration of this call. We were talking about debt and interest expense. The French prime minister just resigned on a no confidence vote. He lasted 9 months, a little more than Liz Truss did a few years ago. He tried to rip out 44 billion in savings, cancel 2 holidays. Not popular. So expect a few more kerfuffles in the marketplace. And my friends, if you don't have Quanted, I'd give them a call because you're not going to see them coming. We have these. This is not in the data. It's not. This is new stuff. It's decades old. It's going to be financial repression. That's going to be different than 08. And coming to a theater near you, or a portfolio, I should say.
Absolutely. That president is probably the only person in France who's ever been fired. So
Premier, yes. Macron and his high school teacher are still there, but no, this guy Bayou's out.
Bayou's out. There we go.
Okay, so to wrap this up, we're at about an hour and 20 minutes, actually. So we've gone over a bit, but hopefully it was interesting. I'll just kind of fill in the blanks a little bit for you, Charlie. So you can find out more about Quanted at quanted.com. Charlie and Quanted are both on LinkedIn. Less of a presence on Twitter/X, but anywhere else. Oh, and I think a bunch of us will be at the Rebellion conference on September 19th. As Charlie mentioned, they're hosting a lunch the day before on September 18th. There's a Columbia conference that Harmonic will actually co-sponsor on, I believe, September 30th. We were trying to make sure we got that final date, but I think we hope to see a bunch of people at the usual quant conferences. I think the season kicked off for me last week. I went to a little quant thing on Thursday. But yeah, through November, there are plenty of conferences, and hopefully we'll see a bunch of people there. And over this time, I am actually more optimistic than ever that investors will start to catch on. And, the story that we're telling when Quanta goes into its next raise will hopefully mean, you guys get the appropriate, amount of capital that you need to go to that next phase, which I'm very excited about as well.
Yeah, as am I, and hopefully not too much capital needed. We have, ideally at this point, agentified most of the internal ops, so trying not to grow. That goes back to that jobs number thing. This is the other thing we see is like all of the startups aren't hiring; they're just building agents to replace people that they would have otherwise hired. So,
but
anyway,
ironically, I don't know if people want to invest in something that's going to grow, and if you say, "Yep, we need a bunch of money to grow," they'll probably be more likely to give you money. Don't tell them that you're efficient and that you can do things.
It's a weird one because they want both. They want both. They want to see, okay, you have a person just orchestrating a bunch of agents. So we now, instead of growing out a full team, you grow out sort of managers of these agent orchestration layers and everything else. And it all turns into this very sci-fi-esque org structure. Anyway, thank you both very much for having me on board. It was a real pleasure and great to learn from both of you. Obviously, you've seen some things that I haven't, and it was great to be able to experience it vicariously through you. albeit not all of them were positive. So maybe that's not the right way of wording it. But yeah, thank you very much, and thank you for having me. And looking forward to seeing the podcast go to more and more success.
Great. Thank you, Charlie. Pleasure, my friend. And good luck continued. And all this stuff, you're going to make into good stuff. That's it. You just take it in and let people make the whole lemons lemonade thing.
Let's see. All right. Thank you.
Next call to the French premiere. I got to go.
Thank you.
Yes.
See you, Bill.